What's up everyone, it's Scotty with MoneyVest. In this video, we are going to be talking about one stock that we need to absolutely start taking seriously because they are turning the corner towards profitability. It's one of the best quality cybersecurity companies out there, in my opinion, after, of course, Fortinet, and very comparable to CrowdStrike. So if you haven't guessed already, it, of course, is going to be none other than Palo Alto Networks, which obviously did jump a little bit over 15% after the earnings came out. And I've been talking about this company, and more specifically talking about this whole concept and this idea that when companies become profitable, it's a whole different new game for them. A lot of institutional participation increases, a lot of engagement, a lot of interaction with that company, a lot of analysts start covering that company once it becomes profitable. So in this video, we're going to break down exactly everything you need to know about Palo Alto Networks. We're going to calculate our intrinsic value. And I know there's going to be some comments about intrinsic value being way too low compared to the market price. And that's how it goes. We're looking for deals. If you want to overpay for a stock, be my guest. And I would love to sell you stock when, of course, prices are way overvalued. I would love to do that. So without further ado, let's just get started. Before we get started, make sure that you drop a like before subscribe to the channel. Link to our Discord and Patreon is going to be down below if you're interested in joining, and of course getting access to all the buy and sell alerts, options alerts, trade ideas. Everything's going to be included, as well as the intrinsic value spreadsheet, and of course our trading view charts. A lot of educational material, and there is a 16% annual discount available till the end of this month. So link's going to be down below. We'd love to have you on board. So first things first, this right here were the actual numbers. And again, we're going to take a look at the numbers in just a minute, but I was actually not going to do this video as soon as I read this first paragraph that reads, the experts, including Jim Cramer, talked about the cybersecurity provider following its fourth quarter earnings report. And I was like, you know what? That's it. I'm not talking about Palo Alto Networks because I don't want to follow the experts, Jim Cramer. But nonetheless, it is, again, a very high quality company. So the numbers being reported, $1.95 billion, a 26% growth year over year, operating margin 28.4%. Again, I have done several videos on Palo Alto Networks. In fact, we have done a cybersecurity tier list of all the companies. I kind of rank them in the quality, and of course Fortinet is at the very top in my opinion because it's already profitable. And then of course I put down Palo Alto Network and CrowdStrike in my previous video. So again, we've talked about this company before in the past. $3.1 billion of billings, 18% growth year over year, $388 million in adjusted free cash flow. That's a 46% year over year, and billings, in other words, the RPOs, the remaining performance obligations, are over 10.6 billion. That's over 30% year over year, and EPS came in on a non-GAAP basis at $1.44 per share. This right here is going to be their entire fiscal year 2023 numbers. They came in either above or at expectations, which is very good to see. 23% growth in billings at over 9.1, almost $9.2 billion. Revenue came in at $6.9 billion, 25% growth. Non-GAAP EPS at $4.44, and adjusted free cash flow margin at 38.8%. So pretty much beating expectations across the board from their own guidance. This right here, continued strong demand for cybersecurity drove our NGS business. So NGS ARR, that's your annual recurring revenue, $2.95 billion. It's a 56% growth on a year-over-year basis, and strong fundamentals for the company. We'll take a look at the numbers here in just a minute, but very nice growth year over year and even sequentially. And this right here, RPOs, also very constant, very stable at over $10.6 billion. And next-gen security ARR also increasing sequentially, so quarter over quarter going up. And of course, year-over-year numbers are also very strong at over 67% growth here. Now, this right here is the guidance from the company for fiscal year 24. I love the fact that these companies provide full year guidance. That's what I want. That's what I look for. Any company, hint Apple, when they don't provide any guidance, that really frustrates me. But Palo Alto Network providing an entire fiscal year guidance, that is huge. $10.9 to $11 billion in billings, just a little bit over $3.9 to $4 billion in next-gen security ARR, so NGS, annual recurring revenue. We got a little bit over $8.1 to $8.2 billion in revenue. That's going to be about an 18 to 19% growth on the top line, 25 to 25.5% operating margin, and EPS expected to grow at 19 to 22%, again, becoming profitable, right? Palo Alto Network was not profitable up until a couple of years ago, so they are turning the corner towards profitability. 527 to 540, it's a pretty good EPS, and of course 37 to 38% adjusted free cash flow margin as well. These right here, over the last 5 years, the cybersecurity market has evolved significantly, and they see $213 billion as their enterprise cybersecurity market. $45 billion of that coming from network security, $11 billion coming from cloud security, and 46 or 48 billion coming from security operations. They're also leveraging the power of artificial intelligence, so AI, to their entire portfolio. So precision AI, which is going to be precision AI, will allow us to deliver unparalleled detection and response to achieve near-term real-time security. And generative AI will redefine and simplify how customers engage with our products and services. So take a look at this. Absolutely fantastic. Consistency is the name of the game. Very nice move to the upside. Revenue, gross profit, operating income has been a little bit more fluctuating, but as I pointed out earlier, they are now finally turning the corner towards profitability with a massive operating income coming in at just over $387 million. Up until last year, they were generating an operating loss. Same thing with net income over here, as you see at the top left, negative $226 million in 2014, and now for first time fiscal year 2023, just over $430 million. Very nice consistency with revenue per share. Diluted share count has been a little bit more stagnant, but it has been going up every single year by about 4 to 5%. So we'll account for that when we're doing our calculation. Excellent margins. So we're looking at 72% gross margins. Net margins are still low because the company is still spending quite a bit of money on operating expenses. Eventually, I do expect this number to expand and that number to go to 10, 12, 15% over time. Free cash flow margins are very strong at 32%. Return on common equity, excellent at 61%. And these two numbers need to be more efficient. So, of course, return on total capital and assets, 3 to 5%, a really, really low number, but eventually it will get better in my opinion. So overall, revenues have grown by 25% since 2018. Since 2014, they've grown by over 31%. And free cash flow has grown by 17.5%. Shares outstanding have gone up by almost 5%. But of course, operating income, net income is only now starting to turn profitable, which is why we need to pay serious attention to this company. They do have, again, negative debt. So more cash than debt on the balance sheet. So negative debt here for the company, negative net debt. That's really good. Current ratio, quick ratio is a little bit of an issue because they are both sitting at under 1, and debt to free cash flow is a little bit over 6. So balance sheet is, I would say, okay. Now, when it comes to valuation, it is trading at a little bit of a higher valuation. So compared to the price as of today, Palo Alto Networks trading at $242. So if you do 242 divided by 535, that's the EPS expectations for fiscal year 24 for the next 12 months, we're sitting at 45 times PE multiple on a non-GAAP basis. That again is going to be that PE multiple non-GAAP forward 45. It's a little bit on the higher side because EPS is only expected to grow 20%. So you were trading at PEG of over 2. Price to sales trading at over 9 to 10. We got price to cash flow at 25. Enterprise value to EBITDA trading at a little bit over 95. But of course, 27 on a forward basis for the company. So it is a little bit on the higher side of valuation here. 533, so that's going to be a 20% growth. So again, 20% growth with a 45 times P multiple. Is that really justified? I'll let you decide. And I know this is one of the reasons. This is exactly the reason I get so many comments in the comments on these videos. They're like, Caddy, your fair value is so low. It's such lower compared to the market price. Well, it's that way for a reason. The stock price is expected, the EPS is expected to grow 20%. Why would I want to pay 45 times earnings for that type of growth? I mean, I would be more interested in paying 20, 25 times multiple for an EPS growth of 20% with a high margin business and a quality company, right? Especially when I'm looking for a deal, I would want to pay even lower prices. But hey, if people want to pay 45, 50, 60 times earnings multiples, be my guest. But this right here is going to be that growth rate for the company. So if you come over to the intrinsic value spreadsheet, we are looking at a 22% growth over the next 5 years from Palo Alto Networks. So what we're going to do is we're going to plug in 20% in terms of that growth rate for PANW. I'm going to go with 25 times P multiple. I'm going to give it a little bit more leverage here. So 25 times multiple. That's going to put our PEG ratio 1.25. Still means that it needs to come down by 20. From 45 to 25, that's a 20 compression in P multiple. Discount rate, we're going to go with 12%, 10% margin of safety, and about, I'll do 4.5% share dilution. Brings our fair value down to $136, and right now it is trading at $242. So that would mean at least a 43% sell-off, which if you take a look at 136, it's going to be sitting roughly, you know what, at around here at these levels compared to, of course, where the price is trading at the moment. So actually 136 is going to be closer to the beginning of this year, January 2023 levels, which I know is going to frustrate a lot of people and be like, yep, so we can't really do anything with this. But that's the whole idea. That's the whole point of analyzing stocks, is to figure out where can we buy them, right? Why else would we be analyzing them? If every stock is a buy, just go ahead and buy them all, right? If we're analyzing them individually, is to figure out, okay, where can we actually be buyers of these companies, buyers of these stocks? Where is going to be that good deal, right? That's the whole idea, is to find good deals. And that's what we're doing with these analysis. So there is going to be some flexibility. So again, these are not set in stone. These are not like super hard values where you have to kind of abide by, but there is, again, some flexibility, plus minus 5%. So even down in the low of 150s is something to consider for Palo Alto Networks. And of course, going over to the technicals here, very, very nice momentum to the upside. I believe we have swing traded this stock before. So I believe we traded this in the past. Correct me if I'm wrong, if somebody's watching this video or a community member. I think we've traded Palo Alto Networks in the past from a swing trading perspective. No, actually, you know what? We have. We definitely have. I remember doing a swing trade over here in January. Of course, we capped ourselves out at 170s, 160s. So we were only able to capitalize, 25, 30%. And of course, from those levels, it has gone up over 83%. So very, very nice move to the upside. But the reason for that swing trade was because of that technical setup. Fundamentals obviously were still playing out, and now the fact that it's profitable, I think it's now for us to consider from a long-term perspective as well for Palo Alto Networks. So hope you guys enjoyed this video, and that right there with that 200 SMA is going to be that support level to watch for PANW. Make sure that you drop a like, subscribe to the channel. Link to our Discord and Patreon is going to be down below if you're interested in joining it. Of course, getting access to all the binds alerts, options alerts, trade ideas, everything's going to be included, as well as that 16% annual discount that does expire at the end of this month. Link's going to be down below. As always, happy investing. I'll see you all in the next video.